presentations. We have 50 minutes. So you do the math with me. We're going to go 12 minutes total time for each presentation. So about 6 or 7 minutes of a pitch followed by Q&A. Okay? We're live? We're good. Patrick, you're our first presenter today.
All right. Good morning, everyone. Thank you for coming. I'm Patrick Thiel. I'm a junior in the AIM program, and I cover international industrials. Today, I'll be presenting Elbit Systems. Elbit Systems is the largest publicly traded defense contractor in Israel. The company develops and supplies airborne, land, and naval systems for defense, homeland security, and commercial applications. Elbit's broad portfolio of products consists of military aircraft and helicopter systems, UAS, USVs, C-41 systems, and electronic warfare and signal intelligence systems. Elbit also operates in platform modernization programs in addition to providing support services. The company is comprised of 5 reporting segments: airborne systems, responsible for 40% of revenue; C4 ISR systems, responsible for 31%; land systems, responsible for 18%; electro-optical systems, responsible for 9%; and other, responsible for 2%. Elbit Systems was founded in 1966 and is headquartered in Haifa, Israel. Moving on to my recommendation. Elbit Systems completed their IPO in 1996 and has since developed into a dominant force in the defense contracting industry. The company acts as both a lead contractor for armies and governments and as a supplier of products and systems for other defense contractors. Elbit continues to be one of the most geographically dispersed defense firms. In 2019, generating 27% of revenue from the United States, 23% from the Asia Pacific, 20% in Israel, 19% in Europe, and 6% in Latin America. In 2015, the company noticed an increase in defense budgets and initiated a strategic plan to gain market share and to win contracts. Elbit reduced its prices, resulting in a 19% annual surge in backlog revenue compared to 10% annual growth previously. Elbit has a market share of just 2% of the global defense spending, but controls 37% of Israel's defense budget. An ample number of joint ventures between and among companies allows Elbit to set up local subsidiaries in order to supply large international contracts without battling for market share. In 2018, an opportunistic acquisition of the Israel Military Industries grew Elbit's backlog from $8.1 billion in Q3 to $9.4 billion in Q4 of 2018. The new addition is expected to add Elbit's rocket and missile capabilities specifically to the Israeli market, 80% of IMI's activity. Elbit reported revenue of $1.8 billion in Q4 of 2018, a 6.8% year-over-year increase, including a contribution of $50 million from their new acquisition, IMI. The full value of the acquisition is to be realized in 3 to 6 years through efficiency measures, integrating Elbit technology with IMI products and sales to new markets. In the last 3 years, the backlog has grown 8% annually, with revenues growing only 5%, and that's just due to contract timing. Looking forward, backlog orders are expected to grow by 25 to 30%, with revenue growth of 17 to 22%. It is recommended that Elbit Systems be added to the International AIM Equity Fund with a price target of $161.18, which represents an 18% potential upside. Now moving on to my investment thesis. My first driver is global arms race. Political and economic tensions have significantly increased as of late, and the new arms race will have a favorable impact on Elbit's ability to grow. The U.S., which amounts to 35% of the global defense budget, has increased its defense spending under the Trump administration with an estimated $664 billion budget for year 2019, up 13.5% since taking office. A new 10-year defense support agreement that begins in 2019 grants Israel the United States defense support of $38 billion, greatly benefiting Elbit. The global market is expected to grow 3% annually, and the new age of technology warfare increase in global terror conveys a demand for tactical solutions and advanced weapon systems. Moving on to my second driver, global demand in cybersecurity. Last October, the United States government warned that weapons produced between 2012 and 2017 were more vulnerable to cyber attacks, mandated disruption, and remote takeovers. In 2018, cyber strength was realized as a requirement for new weapon systems, opening a door for Elbit's cybersecurity product line. The acquisition of Nice Systems Cyber Unit in 2015 added 3 product lines that assist in cyber securitization as well as an education and training service for cybersecurity personnel. The new product line offers offensive and defensive cyber warfare systems as well as commercial applications. Elbit's competitive edge is derived through their dominant position in Israel. Israel's cyber solutions made up 10% of the global industry. The global cybersecurity market is expected to grow by 202 billion by 2021, representing 10% annual growth. Moving on to my last driver, margin growth. The acquisition of IMI will lead to an operating margin growth of 200 basis points by year-end 2021. Israel's pressure to sell the company allowed Elbit to purchase it at an attractive price, giving the acquisition relatively low financial risk. Synergies between the two companies will allow for improved efficiency and sales to new markets, inevitably increasing margins. Margin growth will be complemented by contracts in high-margin geography, such as the Asia and Persian Gulf regions, where long-term contracts will begin to pay off in 2019. I will skip my evaluation in consideration of time and highlight two of my main risks. My first risk is international relations with Israel. Elbit's success is highly contingent on international relations with Israel, considering 80% of annual revenues are exports. Country defense budgets affected by geopolitical events will inevitably determine profitability and growth. And my second risk is government funding. Most revenues are directly or indirectly derived from government agencies. The IMOD and the U.S. Department of Defense are the main customers, and the funding of these programs are crucial for profits. If the funding is reduced or eliminated, it will negatively affect revenues, operations, and cash flow. And with that, I would like to open up the floor to questions.
Thank you. Let's start with Gino.
So with your first driver, you talk about U.S.'s global defense budget.
Yes, sir.
How about Israel's like defense budget? Is that increased or?
Yeah, so the Israeli government actually just came to a decision last year, 2018, that the defense budget is getting bumped up from a minimum of 5% of GDP to 6% of GDP, and their GDP growth is expected to be 3.4% in 19 and 3.5% in 20.
Nice. And then you have the line of like the global market is expected to grow at 3% annually. Where did you get that?
I got that off of either Boeing's or not Boeing, Deloitte's or PwC's Aerospace and Defense Outlook. It's one of those.
So, in one of your risks, talk about government funding. Are you considering like the next like president? Are you kind of betting on Trump to stay in office, or like what's the effect of like possibly a change in government?
Regardless of the next presidency, granted Trump would help Elbit's profits. The race for the new global arms race and the new technology of the cyber era is really taking control. So we see a lot of countries manning up and armoring up regardless of their party in office.
So your second driver, I was just kind of curious how Night System Cyber Unit has been kind of doing, how it's been performing since the acquisition, and maybe like what percentage of revenue you forecasted into the future.
So being that the the analysis I looked at, each report had it already modeled in, so I didn't do any extra modeling of the NICE systems, so I did not have a percent of revenue for that.
It's been doing well though.
Yeah, I mean the merger of the two has been very good.
There are about 7 people who want to ask questions, so we'll go really fast
Okay.
here. Short questions, short answers.
Can you talk about why you use the 2.5% growth rate?
Being that the global defense budget is expected to rise by 3%, I thought 2.5% was fair for a company's terminal growth rate.
Yeah, Sean.
So we know that there's like a huge conflict going on right now between Israel and the Palestinians.
Mhm.
I read that the company doesn't have like a stance on that position, but they had a couple of issues. So is this company just strictly funding the Israeli government, or they what do they fund?
So 23% of their revenue, or 20% of their revenue, is from Israel.
Okay.
So it's not a huge portion of they're pretty diverse. It's 20% in 4 different regions of the world. So they kind of avoid concentrated problems in Israel.
Okay.
And their anti-corruption policy and application is
So the
very
folks like
robust.
provide the US with stuff.
They provide the US and Israel.
Okay.
Yep.
And your first driver, you mentioned a 10-year defense support agreement. Can you just like touch on what that is and how the 38 billion that the United States is providing helps this specifically?
That is Elbit's placement, specifically. They have 37% of Israel's market share. So if the United States is helping out with 34 billion, I assume that they're covering at least 37% of that 34 billion.
I was curious, could you talk a little bit about the governance? Just, there's a private company that owns almost 46% of the total shares outstanding.
He's
You
the
know kind of
president.
Story behind.
Yeah, he's
the
actually
story
the
behind
president
that, how that worked out.
of the company, and he owns 45%. But in all of the ESG reports and everything I read on company governance, the board is very split up. It's 50-50 with links to management and outside of management. And they haven't said anything poorly about him. So I think he has.
Your ESG was an A.
ESG was an A.
Just kind of similar what Sean was asking about, just the breakdown of revenues. So they do derive revenues in other countries other than Israel. Do you have like a country risk premium that you calculated, or how you incorporated that?
I did. I used 0.98% for Israel, and then I used the S&P 500. I used 6% expected or 7% expected return. I'll show you my calculation after class.
Fellow pony man, right? Kentucky Derby tomorrow, everybody.
On your margins,
Yeah.
I get that you're assuming efficiencies from acquisition, but 3% over 3 years seems high, especially going into 19. Could you just explain, I guess, if you're gonna say that much increase in margins, how you see the increase in margins?
Yeah, so they had high margins in 2017, 2018, before the acquisition of IMI. They did some restructuring of debt and they took a hit. It was pretty substantial to the losses in 2018. But management has said that they plan with the acquisition to get back online with 2017 margins by 2021.
Last question, very quick.
So your average daily volume, 11,000, are you confident that we'll be able to make a trade on that if the stock turns up?
Yes, I'm confident just because of the price, and I asked Mr. Walker because that was also concerned.
Oh, you're
Hiring you into it.
Thank you, Patty. All right, Mary Kate, all ready to go? Back to the States now, right? Out of Israel and USA.
Yeah.
Whenever you're ready.
All right. Hi, I'm Mary Kate Simon, and I'm a junior in the A program. I normally cover international consumer discretionary, but today I'm covering domestic real estate. I'll be repitching Walker & Dunlop, ticker WD. The company was actually pitched earlier this semester, but it did not make it into our portfolio. I believe that this company should make it in. On Wednesday morning, they actually reported earnings for Q1 2019. They came out with quarterly earnings of $1.39 per share, beating earnings estimates by a little over 24%. Revenue is up 27%, net income year over year is up 20%, and their transaction volume is up 23%. These numbers reiterate and back up why Walker & Dunlop is a strong company that is growing fast. Walker & Dunlop is one of the leading commercial real estate services and finance companies in the United States, with a primary focus on multifamily lending. Throughout their offices, their product offerings include multifamily finance, FHA finance, capital markets, investment sales brokerage, and bridge financing. Now on to my recommendation. In 2010, Walker & Dunlop established a goal of becoming the premier commercial real estate finance company in the United States. Since then, total revenue has grown at a CAGR of 25%, and earnings per share have grown at a 32% CAGR, causing them to deliver total shareholder return of 341%. As not only an improved lender for many GSEs, Walker & Dunlop ranks number 2 in annual sales volume in Fannie Mae, number 3 in multifamily investment sales brokerage, number 4 in Freddie Mac, and number 3 in HUD lending. This is no surprise as their total transaction volume is growing at a 5-year CAGR of 27%. Their growth was stemmed in 2016 when Walker & Dunlop created Vision 2020. This focuses on customers, capital, and culture, and has led the company to go above and beyond for their customers and provide exceptional financial performance. Through acquisitions, Walker & Dunlop has been able to expand their loan origination businesses, their asset management platform, and their investment sales brokerage business. Within the industry, Walker & Dunlop differentiates itself from their peers as they provide a national platform that offers the capabilities of a large company, yet they personalize the services that is expected from a boutique firm. Given Walker & Dunlop's competitive advantage on their growth strategy within the commercial real estate market, their steady acquisition and joint venture pipeline, and superior execution on services due to the company's culture, it is recommended that Walker & Dunlop be added to the AIM Small Cap Equity Fund with a price target of $69.53, representing a 30.7% upside. Now onto my drivers. The first driver is Walker & Dunlop's steady acquisition pipeline. In Q2 2017, Walker & Dunlop formed a joint venture with Blackstone that has expanded Walker & Dunlop's bridge lending services. Within this interim program, from 2017 to 2018, the loans held for investment in the trust grew 651%, from $67 million to $503 million. Additionally, in Q2 2018, Walker & Dunlop acquired JCR Capital, which has allowed Walker & Dunlop to control more capital, adding for future profitability. Moving forward, Walker & Dunlop plans to co-invest in new capital strategies developed by JCR and to differentiate their service offerings. Also, in Q4 2018, Walker & Dunlop acquired iCap Realty to aid in the growth of their loan origination business. These acquisitions will not only generate greater growth, but they put Walker & Dunlop in a position to grow their market share within different segments of their business. The second driver is Walker & Dunlop's growth strategies. Walker & Dunlop formed Vision 2020 in 2016 to contribute to their 5-year growth strategy. The main components of the plan are to expand their core commercial real estate lending to $30 to $35 billion in annual loan originations and to build an $8 to $10 billion asset management platform. In 2018, Walker & Dunlop originated $25 billion of loans and had $1.4 billion of regulatory and additional assets under management. In just 2 years, Walker & Dunlop originated 51% more loans and had 681% more assets under management. Not only are they expanding their core business strategies, they're also expanding their investment sales brokerage division. The last driver is personnel. At December 31st, 2018, Walker & Dunlop employed 164 loan originators and investment sales brokers. Management continues to invest in all parts of the business as they look for ways to diversify and capture a bigger share of the growing market. Within the last 3 years, producer headcount is up 69%, and in 2018 alone, it grew 13%. With this recent hiring effort, Walker & Dunlop can take incremental market share from the GSEs, the loan brokerage, and the investment sales advisory business. Because Walker & Dunlop has a relatively small national footprint, the growth in the number of producers provides expansionary opportunities. Walker & Dunlop is primed to deliver outsized growth over the next few years. I'm going to skip my evaluation for the sake of time, and I'm going to go over 2 of their main risks. The main risks that Walker & Dunlop face is JLL acquiring HF and the interest rate risk. JLL and HF are large firms that pose as Walker & Dunlop's biggest competitors, and them coming together poses an even larger threat because that could make them the largest commercial real estate finance company in the United States. With that being said, disruption within the firm can pose an opportunity for Walker & Dunlop as well. Interest rate risk is short-term, as movement causes the market to slow down. Once it is settled, transaction frequency continues back to normal levels. And I'm also going to skip management. I open the floor to questions.
All right, we're going to start with Nick.
So over the last 3 years since 2016, it looks like we've been seeing a trend of margin compression. So my question, and then you've kind of got it 2019 through 2021, kind of evening out around 25%.
Yeah.
My question is just, why shouldn't we see that continue to go down? Why should it level out?
Well, historically, from 2012 to 2016, it hovered around that rate. And recently it has gone down a little bit, and that has to do with a lot of the acquisitions they're making.
Mhm.
But I think that it will continue just to level out at that level.
Now that they're done with acquisition,
Not done, but
but
Yeah.
pretty much. Okay,
yeah,
gotcha.
as it like synergizes with it.
Okay, gotcha.
Eric,
So your second driver mentioned the 5-year plan that was in 2016. So it seems like pretty played out at this point. Don't you think that might already be priced in?
So the vision does still have a year and a half left to come to terms. But within that vision, from the start of it, they have grown immensely. And even from 2016 to 2017, their total transaction volume or their brokerage originations grew 75% year over year. And then it keeps going further up. And even in this last quarter, it proves that their growth is still coming in hot.
You say in your evaluation, you use a midterm growth rate of 4%. I'm just assuming that was supposed to be your long-term growth rate.
No. I use a long-term growth rate of 2%, but within my excess returns model, since it was just a 5-year one, I use the midterm of 4%. You put both of those in.
Okay.
And a cost of equity.
Andy.
Can you just walk through your WAC? 5.7 just like, it seems like it could be a little on the low side.
Yeah. So for my WAC, I calculated it and I also saw Bloomberg in fact sets. Bloomberg had a 5.6%, but the numbers I used, my cost of equity was 8.76%. My risk-free rate was 2.5. My equity risk premium was 6.3%. And yeah, I used a beta of 0.96.
What was the cost of that?
I can.
Derek,
Given that this stock has already been pitched, like what's changed between now and then that we should change our minds and I guess put it into the portfolio?
Yeah. The company itself has not, like since March 8th, it hasn't had major changes. I think when it was pitched then, the focus on the drivers and the growth wasn't delivered at the potential it could have been. So, and even with the Wednesday's earnings coming out showing their growth, it shows really great upside for the company.
Connor.
Yeah, so this company is predicated upon its asset growth as one of its biggest drivers. And especially with asset management, I've seen it's really tough to acquire assets like that. How realistic is it that they're going to expand the target goals that they have in mind?
Well, since Walker and Dunlop does do their loan originations and that's continuing to grow, a lot of the times when they do these loans, they stay in contact with the businesses that they help. And now they've acquired that JCR Capital to aid in their asset management. And that's allowing them to have a better platform to own these assets rather than just continue to service them. And even from 2016, when they started focusing on this to now, they have 681% more assets.
James.
So, looking at your 2019 estimate, your price to book there, my first question is one, did you use price to tangible book in your calculations? And then my second one is, so it's increasing there in your estimate of 2019, which in a value standpoint, shows, like not growing financially there.
Yeah.
So can you walk me through like your calculation and then why again you have it decreasing in 2020 and 2021? Like what is changing?
Yeah, so I used book value per share and multiplied it and then divided it to get my price to book. And if you notice, my PE is also going up.
Yeah.
And my EBITDA did too. And that's because when the 2018 actual numbers were released, it was at a set price. And based on this, like they're growing pretty fast right now. Their price has gone up. So that's why that right now it is going up. But as I continue to model it out, it will go back down.
I got one. When I do when I was managing money, one of the things is when you're trying to weigh one company versus the other. One of the things I looked at was just simple relative strength of a stock versus what most comparable company, which is MMI. Have you looked at that and see how well your stock has been either outperforming or underperforming MMI?
Yeah, so Ryan's actually pitching MMI, which is one of Walker and Dunlop's main competitors. And MMI has higher a higher PE and a higher price to book, and that just his revenue and his stuff's already more like the reason mine being lower, it shows more upside. And I was actually talking to I worked for Walker and Dunlop last summer, and I was asking him about why that this company's levels of their valuations are lower than a lot of their competitors, and it's because Walker and Dunlop has not yet gotten to the level of price that their stock deserves yet.
Let's be clear, you're not getting any information
No.
that.
I don't have any insider info.
This is all public information.
Yes.
Right, and just for clarification, because you did work there,
Yes.
do you own any of this stock?
No.
Okay, good. Because we do have that fiduciary responsibility to
Yes,
disclose.
let's make that clear.
All right, Mary Kate. Okay, now we're gonna do an international stock, move from financial services to another financial services and technology company in China. All right, Robbie.
I'm Robbie Metcalf. I'm a junior in the AIM program. I cover international financial services, and today I'll be pitching LexinFintech Holdings, which is headquartered in Shenzhen, China. It's traded on the NASDAQ as an ADR under the ticker LX. So Lexin is included in the broad category of fintech, but really has a leading position and early to market advantage in the consumer online finance niche in China's largest consumer segment, which is educated young adults, including ages 18 to 36. Lexin drives consumers to its website called Benquile and their mobile app through online direct sales, which was 34% of their 2018 revenue. But their true competitive advantage stems from providing lending and credit to its customers at the point of consumption. The related interest and financial service income paid by its customer base represents 36% of its revenue. And Lexin's market position in leading AI platform has allowed Lexin to diversify and add income streams by providing loan facilitation to other financial institutions and charging recurring service fees while not holding the debt, which has grown 27% of revenue, up from 7% in 2017. So on to my recommendation. Lexin's customer base has grown from 20 million registered users and 6.5 million users with approved credit line in 2017 to 37.3 million registered users and 10.5 customers with approved credit lines as of March 2019. So the company utilizes technologies including big data, cloud computing, and artificial intelligence to assess customer credit risk, predict spending and borrowing behavior, and serve the credit needs for users within seconds, where a traditional application would take possibly days or even longer. For 2018, Lexin originated $9.8 billion in loans, representing an increase of 38.5% year over year, which primarily came from the fourth quarter as they began to see benefits from macroeconomic policies encouraging consumption and increased credit. Adjusted net income in 2018 was $298.2 million, which was an increase of 439% from 2017, respectively. And Lexin's total outstanding loan, Lexin mitigates the increase in delinquency risk that comes with an increase in outstanding loan balance and the expansion of their target market by maintaining a 90-plus day delinquency ratio of only 1.41% as of year-end 2018 compared to their peers at 2.54%. And with a massive push for Chinese consumption growth, Lexin's unique customer cohort, and their advantages with institutional funding, it is recommended that LexinFintech Holdings be added to the AIM Equity Fund with a price target of $17.78, representing potential upside of over 37%. So on to my drivers. My first driver, China's consumption growth. China's consumer market is evolving as Generation Z emerges as the main driver of future consumption. And recent data shows that China's Gen Z population spends a bigger portion of their household income than anywhere else in the world at 15%, whereas the US is only at 4%. As a new generation of consumers arise, methods of consumption continue to adapt as the focus has shifted towards technology, product quality, and service. This has enabled Lexin to develop relationships with mainstream financial institutions, ultimately creating a revolutionized model for consumption. and lending. China's GDP recently defied street consensus by reporting a year-over-year increase of 6.4%. And consumption became the driver behind China's GDP growth, which as it represented 76.2% of that growth in 2018, which provides evidence that internet lenders are adapting in the way they operate into becoming a loan facilitation platforms, which aids borrower penetration by financial institutions. The macro theme is that Chinese government is committed to increasing and changing its internal consumption based GDP and becoming less dependent on exports, which they traditionally have used in the past. So my second driver, customer strategy. China's educated young adults have been underserved by traditional financial institutions, leaving a massive market of young credit-craving customers untapped. Large institutions are unable to assess the credit risks of younger customers who do not have any credit history, but Lexin is able to leverage their big data, cloud computing, and artificial intelligence to expedite the traditional loan process and conduct adequate risk assessment in seconds. Lexin's Hawkeye credit assessment engine predicts income potential and behavior of each customer with its sophisticated algorithms and dynamic model. This engine has over 1,000 decision rules utilizing 5,000 potential data variables and has accumulated proprietary data of over 10.5 million customers and 37.3 million credit applications since their application. Moving on to my third driver, advantages in funding. In 2018, Lexin shared that they had cooperated with more than 100 financial institutions, which contributed to roughly 70% of their new loan origination volume. And compared to their peers, which is around only 20 to 30% of institutional funding. So, and getting that funding is crucial for online lenders, as China's regulators have made it clear they will be tightening the peer-to-peer lending. And institutional funding partners are already interested in working with Lexin because of the short-term duration of their products. In addition, the Lexin CEO has stated that they will be establishing a new team this year to provide fintech solutions to these financial partners. I will skip my evaluation for time and move on to my risks. So one of my risks is evolving regulatory landscape. So basically, the timeline with the P2P, so peer-to-peer lending, is kind of in the air right now. However, my company has already had all their documents submitted and been with the regulators through the whole process, and compared to their competitors, have put themselves in a better position. Another risk is the asset quality deterioration. So the company has deteriorating, or the quality of the loans that are facilitated is reduced. The company would result in higher credit costs. And just an economic slowdown. Hard lending, Chinese economy, and over-levered users would hurt them. And I would like to open up
We have about 4 or 5 minutes. I'm going to start with the first one, your revenue mix. The largest segment of your revenue mix is online direct sales. I understand all the other components. That one, what are they selling?
All right, so they have an e-commerce platform, basically. So kind of like a Alibaba and Amazon. And what they do is they act as a facilitator with financial institutions and their e-commerce platform. So they get these loans from the financial institutions, so bigger banks, and that basically funds the purchase, and they don't have to hold that debt. And then these customers can use that credit, which is an average about like $1,000 credit given to them on their credit line. And so they can buy items from like cell phones, laptops, all the way to cosmetic products and even airplane travel.
Okay, Bill, how do you feel about, it seems if they're lending peer-to-peer, that, they're lending to they're sourcing funding from I'm gonna use the term dumb money.
Yeah.
Okay. Now they're doing wholesale. Now they have to go to more established, they're smarter funds, maybe smarter ones. How does that potential change affect the cost of funding and therefore the profitability?
Yeah, so the question was in regard to how it would affect their costs when going to institutional funding.
Yes.
All right, yeah, so the cost could increase basically only if the institutional funding, if they don't require require like 100% guaranteed rate or return. And what happened, or what positions my company so well is that they do have a guaranteed funding license from regulators, so they can offer these institutional banks 100% guaranteed for the funding back, which limits their costs for like delinquency and not being able to pay that back.
Manning, Connor, we gotta be quick with questions, okay?
Since their IPO, they've been pretty volatile. Can you just touch on the steep decline all the way down to $6.48 and then all the way back up to now 14, 13.
Yeah. So they IPO'd in 2017, so there hasn't been a ton of data, but as last year, the whole index pretty much for financial companies was down, and that was part of too just like the economic behavior. And as things have been moving along, they've seen ROE in 2018 increase by going from 5 cents earnings per share to $1.65.
So you're just attributing it to the index going down?
Yeah, pretty much. Yeah. And I mean, there's uncertainty as well as with the peer-to-peer lending. But what they have done is change their peer-to-peer lending versus institutional funding, going from 30% to 30% institutional funding and 70% peer-to-peer. And they've reversed that. So now they have 70% institutional funding and only a 30% peer-to-peer lending. And peers, all their peers hold about 30% institutional funding, and they need all of that.
Yeah, I'm just curious, under 2021 numbers, since people was not here for 5 years, does it have like?
Yeah.
That's anything like, growth margin that would get numbers?
Yeah, I can, I have it in my model. I can get back to you. I used the 2017 in my box just because they did IPO in 2017.
Right.
So there isn't a lot of historical data, so I thought I'd disclose that.
Yeah, I'm just curious.
Yeah, I can get back to you.
All right, real quick, Connor.
Yeah. Do you think China will continue to promote economic stimulus, evidence GDP growth, or do you think it's will slow down?
I think that it'll continue to increase as they've made it clear that they want to focus more on internal consumption rather than exporting goods, which they've done in the past. They really want to focus on stimulating their own market instead of using what they have, like in selling it. They want to make it and sell it back.
Ed, quick.
Do you have market share numbers for like their companies and maybe peers? Do you have market share numbers with you?
I don't have like specific market share numbers with how that works, just because it's such a growing industry and it started off smaller, and as institutional like funding and the peer-to-peer lending timeline continues, those will be more clear.
Short is good. Can you do short?
Your midterm revenue growth rate estimate, 2%. How's that calculated? Of the 5-year of estimates, or?
That was just used on a base from like company consensus, as well as just my model, and I used those.
Is it on the 5 years that you modeled?
Yeah.
Okay, gotcha.
Last question.
So the firm's up 6% today.
Yeah.
Can you, what's that attributed to?
Yeah, and that's just again with they've recently reported in March that their institutional funding is stronger than all competitors, and that's pretty much the biggest thing for them.
Yeah, now they're only up 4.9%.
Yeah. So, and I mean, also the entire market over there went down yesterday, while and my stock went up 4%. So, being able to produce positive numbers in a negative day is good.
All right, thanks, Robbie. All right, Ryan, you're the last presenter today, last presenter of the semester. And while Ryan's going up there, those of you who presented today, I need your buy-sell recommendations. Others of you who have sells or adjustments, and I know there are some of you, please submit those to me again so that we can put one large ballot together. Yes. Yeah, we'll talk after class. We'll talk about specifically what you might do. Okay, everybody got that? All right, Ryan.
All right, good morning. My name is Ryan Dahlen, and I'm a junior in the AIM program studying finance and economics. And today we'll be pitching Marcus & Millichap, ticker MMI. Marcus & Millichap is a leading national real estate services firm specializing in commercial real estate, investment sales, financing, research, and advisory services with over 80 offices across the United States and Canada. MMI engages in the provision of investment real estate brokerage services, and the company was founded by George M. Marcus and William A. Millichap in 1971 and is headquartered in Calabasas, California. MMI is much like the previous stock I pitched, Walker and Dunlop. However, Marcus and Millichap focuses on a smaller market segment of the commercial real estate market, the private client market segment, which consists of $1 to $10 million transactions and comprise 84% of the total United States commercial property transactions in 2018. With nearly 2,000 investment sales professionals, MMI has the ability to begin expanding rapidly in different markets. Over the course of the previous year, MMI has acquired 3 different real estate brokerage companies, 2 in Canada and 1 in the United States. In terms of the company's private client market segment, which is driven by high net worth individuals, partnerships, and private fund managers, MMI is well positioned to dominate this market segment with the highest commission rates. Due to MMI's impressive growth strategy and proven business structure, it is recommended that Marcus and Millichap be added into the AIM equity fund with a price target of $51.53, representing an upside of 19.78%. Now moving on to my drivers. A national platform. MMI continues to improve upon its state-of-the-art platform to maximize value for the real estate investors. The system generates real-time buyers and sellers and matching the buyers and sellers, which maximizes the value. According to Google Analytics, the company's website averages 71,000 new visitors per month. With continued growth of the platform MMCC, it is expected that their platform will reach 16.4% year-over-year growth in financing fees, as well as their internal marketing system, MNet, which allows the sales force to share listing information across the country efficiently, which increases then their sales force efficiency. In my next driver growth strategy, even through weak economic times, MMI continues to be the leader in $1 to $10 million private client market segment. The market that MMI operates in is underserved and fragmented, and has historically had high barriers to entry. The top 10 brokerage firms have only accounted for approximately 24% of 2018 transactions, and provides MMI the opportunity to expand and bring services to a larger portion of the market. JLL, a competitor of MMI, recently acquired HFF, another competitor. It is believed that this will help Marcus and Millichap expand in the market and gain additional market share. And my final driver is selective acquisitions. MMI looks primarily for accretive acquisitions of small to medium-sized brokerage and financing businesses with consistent revenues and earning trends that will expand the company's geographic and property type coverage, as well as the EBITDA margins. The acquisitions that were made in 2019 allowed financing fee revenues to rise 8.2 million or 16.4%. With continued expansion into new markets across the United States and Canada, MMI has the liquidity in cash and cash-related assets on hand to continuously expand their margins and increase their market share without taking on debt. In order to reach an intrinsic value for MMI, a 10-year excess return model was created using a terminal growth rate of 1.5% and a cost of equity of 10.57, which resulted in an intrinsic value of $61.92. A sensitivity on the terminal growth rate and cost of equity ranged from $56.78 to $72.12. HFF, a comparable to MMI, has recently been acquired by Jones Lang LaSalle Incorporated as a precedent transaction of 13.5 times EBITDA. Using the same multiplier for MMI gives a value of $50.70, an upside of 18%. An EBITDA multiple was also calculated using a blended average EBITDA multiple of 8.96 times, resulting in an intrinsic value of 32.36. By weighing the 3 models 40, 40, 20, a price target of 51, 53 was reached, resulting in a potential upside of 19.78%. And MMI does not pay a dividend. Moving on to my risks. Economic conditions, credit and liquidity risk may adversely impact Marcus and Millichap. Historically, the commercial real estate market has been cyclical, and these cycles in the real estate market may lead to similar cycles within MMI's earnings and stock price. Laws regarding independent contractors. Most of the investment sales professionals are subject to IRS regulations and state laws, and laws could change affecting the company's the employees' compensation and commission structure of the investment sales professionals. Many of Marcus and Millichap's investment professionals are often recruited by other companies, and there are no agreements to which for most of the key employees, and no assurance that MMI will be able to retain these professionals. And finally, loss of transaction fees. MMI has historically earned principality on all the company's revenues from the real estate brokerage transactions and financing fees. Marcus and Millichap expect that they will continue to rely heavily on the revenues from these sources for substantially for the foreseeable future. And in the interest of time, I'm going to skip management and open up the floor to questions.
All right, we're gonna do Gino first, then Derek, and then Derek Kate. Gino.
So looking at a 1-year chart and a 2-year chart, it seems like MMI absolutely crushes Walker and Dunlop. What do you attribute that to, and then how do you see that going on in the future?
Well, I attribute that to the market segment that MMI serves, which is the private client market segment. It is the largest segment in the commercial real estate market, and MMI has a huge market share within that market segment, and it is underserved and fragmented, like I said. And with the recent acquisition of HFF, it only allows for Marcus and Dunlop to continue expanding rapidly.
Okay, who is next? Derek.
Yeah, your EBITDA multiple projects a downside of like 25%. Can you just talk about that, why you included it?
Yeah, I included that one because I just thought it was fair since I used a present transaction value using an EBITDA multiple. So it just provided fairness for my model, I feel like. Thank you.
I just have a few questions on your comps. Why did you include both HFF and JLL if they're combining? And also for your EBITDA, you put Walker and Dunlop at 4.45, but in 2018 the actual numbers were 12.1, and I predicted them to be 12.6 in 2019. And that just like pretty much like screws your whole valuation in that sense, because that's a huge difference. So can you just talk on that?
Yeah, so I included HFF and JLL because they were just two competitors within the market, and since it's recently being acquired, it was just to show history. And then I'll have to get back to you on the second half of that question.
So looking at 3 brokers' outlooks here, 2 of them are from Wells Fargo and William Blair. They're both rating at a hold with 39% target rate. So I'm not saying your valuation is incorrect. I just want to know, what do you think you're seeing that these analysts are not?
I see Marcus and Millichap expanding rapidly in the private client market segment because now that a competitor is gone, which allows them to expand even faster. And with their acquisitions, they plan on making many more, and with little debt, it just increases. It just proves that the company is able to expand and increase their market share.
Can you just explain to me why you decided to use a precedent transaction multiple rather than typical other multiple?
Yeah, so I used the precedent transaction multiple because the companies were very similar. HFF serves in the same market and everything, so using the precedent transaction multiple, it just provided clarity. And I did also value the company using other relative valuation methods. Just when talking with Walker, precedent multiple made sense.
Okay, I'm losing track. Who's next? Andy.
Yeah, so you use the 10-year excess return model, which is fine, but we only see 3 years. And your 3rd year, if sales are growing at 13%, and there's a lot of other stuff growing at pretty high rates. Can you just like summarize what the last 7 years of your excess return model, like how much is sales, like is sales growing slower than everything else? Like,
with the excess return model, I did forecast with the cloud of a constant of 13% as they have been historically over the past couple of years. I do have it slowing down towards the end.
Nick.
Just kind of piggybacking off of that, with the 10-year model, do you think, and then kind of going along with Jimmy's at the 39 target price on FactSet, do you think that we're going to have to wait beyond our investment horizon to see the upside on this?
I do not believe so, no.
Okay.
Connor.
Yeah. So when your competitors pitch, because it's not that gives pitch, so for all construction standpoint, how do you justify that you have both in there, or is your company better than her company is?
I believe that Marcus and Millichap has a better expansion opportunity, especially with this recent acquisition and their impressive growth and the market that they serve.
We didn't want to turn this into a
I know, I
conversation.
know. Well, I'm just curious.
Because we can do both, okay?
Yeah.
First of all, let's be clear on that.
I know. I'm just
Yeah.
I'm just curious. curious why you think that when JLL is acquiring HF, why you think that's an opportunity? Like, there's, that firm is now gonna be the premier commercial real estate finance company in the country, and one doesn't just like disintegrate.
Yes, but HF focuses more on like large scale, and they did do some small, but now it's just allows for MMI to just completely expand into the private markets.
Debate class.
Well, just a comment. So I think this is really good to have a competitive company recommend at the same time, because that's what we do all the time. Is somebody say, well, what about this? Why don't you recommend this company versus that company? And if you don't have your ideas distilled down and understanding what exactly this company does and how well it does it, that'll come out in a quick Q&A. And I think, in my experience, that was always helpful to understand.
These are slightly different niches that they participate in, so they're not, even though they're peer comps, and that's appropriate, they're not completely direct. This isn't Coke and Pepsi, right? But it's Coke and bottled water. Right?
No, like Sprite.
Yeah. All right, Brian, thank you very much. All right, one more time here. Buy, sell recommendations, not only for what was pitched today, but if there's any other adjustments to the portfolio, we'd like to do that, okay? All right.
What's up, James?